Stop everything you're doing right now. A financial reset, one that will directly impact every dollar you own, has just been triggered. And if you hold any form of U.S. wealth cash in the bank, stocks, retirement funds, this is the single most important video you will watch this year. What you're about to see is not a random series of events. It's a coordinated, deliberate strategy with one ultimate goal: to manage an unpayable national debt by reshaping the very foundation of our money. And if you don't recognize the playbook, you will unknowingly become the one who pays for it. My mission today is to make sure you aren't. Today, we will deconstruct this entire monetary shift. First, we'll break down the core reason this reset is not just likely, but inevitable, the terrifying math of our debt. We'll connect the dots to recent geopolitical moves involving the world's largest oil reserves. We'll expose the decades-long suppression of precious metals and why that dam is finally breaking. Then, we'll walk through the historical blueprint they're following, a playbook that has quietly transferred wealth before. Finally, we'll outline how you can position your assets not just to survive, but to potentially thrive during this transition. Every timestamp is listed below. Now, to grasp the scale of what's happening, you must first confront the numbers that make it unavoidable. The United States carries a national debt exceeding $38 trillion. That translates to over $100,000 for every single American. But here is what turns concerning into critical. We are now paying nearly $1 trillion every year, just in interest. That's right. This interest payment is now the government's second largest annual expense. We are borrowing new money simply to service old loans, a classic debt spiral with no easy exit. So, what are the possible solutions for those in power? Let's walk through the grim options. Option 1. Austerity. Slash spending and raise taxes dramatically. But any politician who seriously campaigns on cutting entitlements or significantly increasing taxes commits career suicide. Even if attempted, the resulting economic contraction would likely worsen the debt burden. Option 2. Outright default. Refuse to pay. But U.S. Treasury bonds are the bedrock of the global financial system. A default would trigger catastrophic collapses in pensions, banks, and markets worldwide. It's an unthinkable nuclear option. Option 3. Grow our way out. Achieve sustained, extraordinary economic growth to outpace the debt. The required growth rate, however, is far beyond any credible projection, especially for the decades required. That leaves option 4, the only path remaining that avoids immediate political or economic collapse. It's called financial repression. The strategy is to deliberately allow the value of the currency to erode over time, so that the debt is repaid with dollars that are worth far less than when they were borrowed. In essence, it's a silent, slow-motion default that transfers wealth from savers and lenders to the debtor, which, in this case, is the government itself. Major financial institutions are now openly warning that this is the probable path forward. They predict policymakers will tolerate higher inflation while keeping real interest rates artificially low. This isn't speculation. It's a documented historical tactic. But to execute it without public panic, they need to control 3 critical levers. The first and most crucial lever is energy. Why? Because headline inflation is driven by what people feel immediately, the price of gas and groceries. If energy prices skyrocket, public anger forces political action. Therefore, managing inflation perceptions requires managing oil. This brings us to the recent seismic shift in Venezuela. The nation holds the largest proven oil reserves on the planet, roughly 300 billion barrels. That's about 17% of the global total. For years, production there has been crippled. The recent change in control opens the door for massive investment to unleash that supply. From a purely economic standpoint, this gives a dominant influence over global oil price stability. Control this spigot, and you gain a powerful tool to keep energy prices and thus visible inflation in check, even while letting inflation run hotter elsewhere in the economy. The second lever is the direct control of money itself via the central bank to keep borrowing costs suppressed. We're already seeing this in the rhetoric and pressure surrounding interest rate decisions. The third lever, however, is the most deceptive: the suppression of precious metals. Why would they need to control gold and silver? Because these are the ancient alarm bells for currency debasement. When faith in paper money falls, people flee to hard assets. If gold were to suddenly triple, it wouldn't mean gold got more valuable. It would scream that the dollar got much weaker. That's a signal they cannot afford to let flash. For decades, evidence suggests major banks have systematically capped prices through mechanisms like paper futures contracts, where hundreds of derivative claims exist for every single physical ounce of metal in concentrated short positions. The goal was to create a mirage of stability. But this suppression scheme is now breaking down. Why? Because physical demand is overwhelming the paper game. Central banks worldwide are buying gold at record rates. Industrial demand for silver, especially from solar panels and AI data centers, is soaring. Nations are implementing export controls. When the demand for real, tangible metal collides with limited supply, the paper pricing mechanism fractures. The dam is cracking. The silent tax of inflation targets the unprepared saver. This brings us to the historical playbook, and it's one we've seen executed successfully. Look at the period following World War II. U.S. debt surpassed 100% of GDP. How was it reduced? Not through surpluses or dramatic growth alone. The Federal Reserve kept bond yields below the rate of inflation for years. This created persistently negative real interest rates. Savers and bondholders steadily lost purchasing power, while the government's debt burden shrank in real terms. According to economic studies, inflation and financial repression were responsible for erasing roughly half of that massive debt burden. It was a stealth wealth transfer on a national scale. The same blueprint, with far larger numbers, is on the table today. So, the pivotal question is, how do you personally navigate this? How do you avoid being on the wrong side of this wealth transfer? The core principle is this: the system is engineered to reward asset owners and penalize long-term cash holders. Your strategy must flow from that understanding. First, consider equities in companies driving real economic growth. Look for high revenue growth, expanding profit margins, and durable competitive advantages. Second, allocate a portion to tangible, finite assets. Physical precious metals and key commodities have been suppressed, but that dynamic is shifting. Third, be extremely wary of long-duration bonds. Lending money to the government at a fixed 4%, while real inflation runs at 7%, is a guaranteed loss of purchasing power. Fourth, strategic real estate with fixed-rate debt can be powerful. As inflation rises, your debt becomes cheaper to repay in real terms, while the property value may appreciate. Fifth, critically evaluate your cash holdings. While you need liquidity for life and opportunities, excessive cash is a melting ice cube in this environment. In a monetary reset, assets are armor. Cash is kindling. Finally, think internationally. As the dollar's dominance is challenged, diversification into other currencies and economies can provide a crucial hedge. The goal isn't to predict every twist, but to build a portfolio resilient to the overarching trend of currency erosion. Before we conclude, I must mention a crucial partner that helps make this channel possible. Our sponsor today operates in a sector absolutely vital to global trade, yet one most investors never see. I'm talking about marine fuel logistics. Consider this: over 80% of everything transported globally goes by ship. Those ships require immense amounts of fuel, delivered with pinpoint precision across a maze of global ports and regulations. It's a monumental logistics challenge, not just a simple commodity business. Our sponsor, Oceanic Fuel Solutions, ticker OFS, is a Singapore-based leader in this space. They don't just sell fuel. They provide the critical infrastructure and coordination that keeps global commerce moving. Their recent growth metrics are striking. In their latest half-year report, revenue jumped over 50% year-over-year. Their operational scale has exploded. Transaction volume up 75%, fuel tonnage delivered up 90%, and their global port coverage has nearly doubled. They've secured long-term contracts with major players, providing revenue visibility. Now, full transparency. Off-Fees is a smaller company, and this sector has thin margins and competition. The stock carries volatility. This is not a personal recommendation. You must always conduct your own thorough research before any investment. But their story, a company at the heart of indispensable global trade, demonstrating rapid scaling in a complex industry, is a compelling case study. You can find a link to learn more in the description. That brings us to the end of our breakdown. The gears of a monetary reset are in motion. The playbook is not new, but the scale is unprecedented. Your awareness is your first and most powerful defense. If this video clarified the hidden forces shaping your financial future, please do one thing to support this channel. Hit the like button. It truly helps us deliver these vital breakdowns to you. For Winds of Thought, I'm your host. Thank you for watching.